Nearly half of Americans who navigate the credit market are struggling with bad credit. This statistic is born out of the U.S. Census Bureau in a 2010 survey which tracks the number of citizens who carry debt, who pay on time, and who make late payments. The numbers are staggering when taken in as a whole, but on a case-by-case basis, the numbers would imply that individual consumers who are routinely falling behind on their debt payments may be repeating the mistakes that got them into a bad credit situation in the first place. Seldom does the subject of personal finances ever come up in schoolrooms, and ignorance may reign supreme when it comes to managing personal debt and income. It comes as little surprise that many consumers will seek car financing with bad credit at some point in their lives. For the most part, individuals find themselves in a bad credit situation as the result of carrying more debt than their incomes can support. This is referred to as having a high debt-to-income ratio and is a leading indicator that a potential borrower is a high risk for car financing. The debt-to-income ratio can send up a red flag to lenders that, in spite of having a good income, poor management of personal debt can make that income irrelevant, as too much of those earnings have to go out in order to service the debt. Adding to this burden would simply be more hazardous to both lender and borrower. For this, the consumer must keep on top of his or her debts on a monthly basis by establishing a budget, making all payments promptly and not assuming more debt than the budget will allow. A personal budget is a simple concept and only requires that an individual keep track of their spending habits, allocate portions of their income to certain necessary expenses, savings, and allow for the use of disposable income. The whole thing can be done with a pencil and paper. No expensive software needed. Though many try, a person can't live with bad credit. Fixing the problems that drive an individual's credit score down takes time and patience, but are worth it in the long run as it saves the individual money, a lot of money. There are penalties associated with having bad credit, which many consumers are willing to pay instead of dealing with the immediate problems in their finances. Repeating the mistakes that keep them underwater, these individuals will suffer late payment penalties and higher interest rates on financing rather than do without a few luxuries. With these upside-down priorities set, they will continue to drive their credit scores down, thus pushing themselves out of the credit market altogether. Car financing with bad credit is one thing, but car financing with no credit is something else entirely. Going back to the budget, it is a matter of some urgency that a person allow as much of their income as possible to pay off existing debt. This doesn't mean credit accounts have to be closed, but they must be paid in order to improve one's standard of living. Once creditors are satisfied, credit scores start going up, and the money that would otherwise be spent in interest payments and penalties would go back to the pocket of the consumer. Bad credit costs money. If there are any consumers scratching their heads wondering why someone who is short on money has to pay even more money for owing money, the answer is simple. There is a cost associated with processing late payments, as new statements have to be issued, phone calls must be made, and the individual's balance and interest need to be recalculated. This translates to a penalty that must be assessed to the customer to discourage the behavior in the future. The principle is similar with regard to interest payments. Higher rates are a matter of compensating the lender for the higher risk posed by the borrower who has bad credit. In the matter of car financing, a lender is taking a chance on someone whose credit score indicates he or she has bad credit. While it can be argued that there are different kinds of bad credit, the result of having it are the same: higher interest rates. When trying to get car financing with bad credit, it's important that a borrower not take the word of anyone that their credit is indeed bad. It's up to the individual to find out how bad it is and why it's bad. Everyone should know his or her 3 credit scores and the contents of his or her credit report. While a credit score has specific definitions attached to the numbers, there may be different interpretations used by lenders of what that score actually means. Someone living just below the score for average credit, a score of 619 or so based on the FICO system, might be considered a fair bet in getting approved for car financing, given the criteria some lenders use and charge an interest rate closer to the prime rate. Other lenders might consider that same individual a higher risk and charge a significantly higher interest rate for what that lender would deem a subprime car loan. This means that anyone who believes they must seek a car financing for bad credit may, in fact, qualify for a better loan if they have examined their credit reports, found errors, and had them corrected. The result is a lighter burden when it comes to getting car financing and paying it off. Credit is not a matter of keeping a few bits of plastic in a wallet. It requires constant maintenance on the part of the consumer to make sure that all records are accurate, all bills are paid, and all debts don't exceed that consumer's income. By not taking charge of their own credit history, many consumers end up throwing money away on late fees and higher interest rate payments. Every consumer has unrestricted access to their own credit reports and credit scores, so there's absolutely no reason not to be in total control of one's own finances. In some cases, moving to a better credit rating can mean the difference in a few points in a credit score, and car financing with bad credit becomes car financing with good credit. Federal Auto Loan. Good credit, bad credit, no credit, all good.